and welcome to the webinar today, Allocating to Alternative Credit. My name is Sebastian Colkin-Scott, and I am the editorial director here at Savvy Investor. So what is alternative credit, and how do investors know if it's right for their portfolios? To help answer these questions, I'm joined today by Anders Persson, of Chief Investment Officer and Head of Nuveen Global Fixed Income, and Randy Schwimmer, Co-Head of Senior Lending at Churchill Asset Management, which is an investment specialist of Nuveen. As a reminder, this call is open to financial professionals only. So without further ado, let me introduce our investment experts. So today we have Anders Persson from Nuveen Fixed Income and Randy Schwimmer from Churchill Asset Management. Thank you both for taking the time today to share your thoughts with us and helping investors with their alternative credit questions. The topic for today's webinar was triggered by Nuveen's institutional investor survey, and their recent findings of their annual survey highlighted the ongoing march into alternative investments and private credit. So Randy, we look forward to benefiting from your experience and expertise today in private credit. What insights surprised you most about the equilibrium?
Thank you, Seb. I appreciate the opportunity to be here, and it's always a pleasure being on with my partner, Anders Persson, who is probably one of the most well-respected folks in fixed income in the industry. So this is a great opportunity to talk. I mean, I think what surprised me about the survey is what, the percent of people who actually are thinking the way we're thinking right now in the midst of so much change, both in the market and in the economy. Alternatives as an asset class, something that has been on the minds of a lot of investors, just given the amount of volatility, things changing all the time, inflation, interest rates, and so forth. And it's very helpful to see that the views that we have about the asset class are shared by so many people. 64% of those surveyed actually are rethinking their portfolio construction as a result of what's going on to include more alternatives. 75% are expanding their search for yield, and given the fact that interest rates are rising, having a floating rate asset as part of their portfolio is something that seems to be of more interest. And over 60% are seeking some kind of hedge against inflation. So those kinds of things are probably very obvious given the backdrop, but it's great to see. We think that the drivers of those trends, inflation rates and volatility, will continue for some time.
Thank you, Anders. Obviously, given the macroeconomic backdrop with rising interest rates, rising inflation, and questions about the ability of central banks to manage so-called soft landing, many investors are likely to have questions about how traditional fixed income assets and alternatives will fare. So with the audience now, we are actually going to run a quick poll. To the audience, you should have a pop-up on your screen. The question is, do you expect a US recession within the next 18 months? With the answers being yes, no, or don't know. So whilst we give you a few moments to answer that question for us, Randy or Anders, do you have some initial thoughts on which way it'll go, or share your views on it?
Sure, Sebastian, I can jump in here a little bit. I would say that certainly that topic is very much top of mind, both with investors, for markets, from clients. We're hearing that a lot from clients, and it's something we discuss here internally on team at Nuveen a lot, naturally. And I think it's important to remember that these are unprecedented times. There are a lot of crosswinds, a lot of uncertainties in the macro environment. So I think we're approaching it sort of with an evolving view here, an evolving approach. We have a lot of debate internally, but I would say definitely our consensus view, and I don't want to influence kind of people's polling here, but that the odds of a US recession over the next 18 months are definitely increasing quite meaningfully, particularly kind of perhaps post the CPI print that we saw this week as well. So, obviously the Fed is really trying to stay on top of this, and the risk here, of course, is that they're going to have to raise rates so aggressively that it will kind of spin the economy into a recession here. So I would say we're not just talking about if it's going to happen or not, but we're also discussing a lot about how severe of a recession could be we facing here. So if we enter one, how is it going to look? Is it going to be more shallow, a little bit more of a technical recession, or something more severe? So as it's been kind of, a little bit of the market environment for some time, there's a lot of uncertainties and a lot of different views here. So I'd be curious to see what the polls come in here in a second.
Yeah, and I would just add to that I'm personally really bad at predicting recessions. We were thinking from pretty much 2017 on that there was going to be some sort of downturn. Everybody was asking, what inning are we in? Is the expansion over? And I was on record at the end of 2019 as saying, well, I've been wrong so many times that, I keep expecting, this the recession to happen. So I think it might happen in March, but I'll probably be wrong again. And of course, March of 2020, we did see a downturn having nothing to do with the economy per se, but having to do with COVID. So again, who knows? I think that people are getting more concerned because of the pace of interest rates in the U.S. We may even be in a recession right now. The first quarter was a negative GDP number, negative 1.8. We could theoretically be in one now, but I do agree with Anders. I think it's going to be soft. And of course, the whole point of alternatives is to be prepared no matter when the recession comes. So having a portfolio that's defensive in nature, companies that are less cyclical, having structures that if we do go down into a downturn will be more resilient, and projecting ahead so that when you're looking to finance a business, expect that business is actually going to be in a recession within 18 months and see how the numbers look. And if they look too tight in terms of coverage and things like that, it's probably not the business to finance.
Great. Thank you both for sort of sharing your initial views. Thank you to the audience for submitting their thoughts. So unsurprisingly, 78.6% of the audience think that there will definitely be a recession within the next 18 months. So sort of that sort of coincides nicely with both of your views. And so moving on, Anders, I'm happy to pass over to you.
Yeah, I think we were thinking maybe as a bit of a backdrop to that poll and sort of setting the stage here for Randy and I to run through a few slides to give you a little bit of a flavor of what we're looking at and how we're kind of processing the opportunity sets and again, tying that into the alternatives overall. We've always stressed there's a lot of uncertainties. There's really no kind of historic playbook in the market that we can kind of go to. But there are a couple of key takeaways, I think, partly from the poll that I would kind of stress. First, I would say there are some good news here, actually, despite, a little bit of a gloomy type of poll there and in line with Randy and my expectations. But I think the good news is, despite this sort of tough market backdrop, economic backdrop as well, the good news is that the credit markets have priced in a lot of these uncertainties, including what you mentioned here a second ago, Sebastian, meaning inflation concerns, where economic growth heading, rates, and Fed hikes and what have you. From our perspective, I think that generally the fixed income markets, particularly the public side, has done quite a good job pricing this uncertainty in. And I think it's done a better job, quite frankly, than other parts of the market. So I think the credit and the fixed income markets have been quite proactive and basically taking this view and again, pricing that into the market. I think it's kind of nicely highlighted here on this slide. And if you look here sort of on the top, it's really showing that the opportunities in the fixed income credit, in my mind, has changed dramatically this year and really in the last few months. The yield levels are materially more interesting now from a fixed income investment perspective than they were, let's call it the beginning of the year. If you look at the yield difference from, let's call it December 31st of 2021 at the top versus mid-year on the bottom portion here, just looking at a few examples, U.S. Ag has gone from 1.75% to 4%, IG corporate from 2.5% to 5%, high yield low 4% to 8.5%. That's truly high yield again, and that's materially different, obviously. And even on the last row where we show the spread kind of situation, spread basis is also wider than historical averages. And I think the key takeaway here is that the markets have priced in a lot of these uncertainties, and we're certainly not saying, and we would expect to see continued volatility, continue to kind of push and pull between the markets as they're trying to assess inflation concerns, recession concerns, Fed kind of type steps, what have you. But nonetheless, the market, I think, has done a very good job, and the yield profile is a lot more interesting. The second key takeaway here, I would say, is that diversification is more important than ever. This is not a market where you can just buy any asset class or all asset classes. It's not really one asset class that sticks out as, particularly cheap necessarily. You have to spread your bets more wisely. You have to be a little bit more dynamic in your approach. You have to look throughout the entire investable universe and really do your work. I mean, this is going to be an environment, in my mind, and I think Randy would agree, you have to be diligent in your underwriting. You have to be thorough and really kind of rely on, in my mind, income and carry to drive return for this year and next. So it's a long-winded way of saying that there are a much more interesting opportunity set here from a relative value perspective. And as you're looking across the diversification kind of aspect, looking at both traditional and alternative credit, I think is a lot more prudent and important here going forward. Randy, maybe I'll open it up to you. Is there anything that you want to add to this slide here from your seat?
That's a great summary. I think it's interesting too that, and you pointed out the difference between the high yield bond market then and now. At 4%, one could argue that was certainly not high yield. It may have been high yield relative to the risk-free rate. And it seems now that risk is actually being fairly priced in both those credit categories, both high yield bonds and in leveraged loans. I would make two other points. One, compare the investment grade corporate yield right now at 5% to where non-investment grade high yield was, back at the end of last year. So that just shows you how far the risk reward spectrum has gone, where investment grade is actually paying what high yield used to. The other thing is that the middle market loans have come up modestly in terms of their spreads, but not as much as the leveraged loan market. We're seeing, and we'll talk about this perhaps a little bit, we're seeing a point in time where the liquid loan market is actually being priced. The prices of the secondary market have actually come down pretty significantly in line with probably public equities in terms of what's going on there with valuations, which has created a spike in yields, which makes leveraged loans actually more attractive from just a pure spread perspective than the middle market. That typically doesn't happen because of the illiquidity premium that's built into middle market loans, but it's happening right now.
Yeah, for sure. And I think, Sebastian, if we go to the next slide, we had a couple of more thoughts here, just to kind of drive a little bit of a discussion here. I think, from an investment approach, again, the different environment that we're in today versus, let's call it 6 months ago, is also in our mind reinforcing what we've been doing for some time, I would say, both on the Randy's team and our team. I think a lot of investors were attracted to, or had to basically stretch their investable universe, really to find yield. I mean, as we just looked at a few seconds ago, the yield levels were so low that investors really kind of felt like they had to look for other parts of the market beyond traditional fixed income, beyond ag investing, treasury investing, to meet their yield bogeys and kind of having that fixed income portion in their broader portfolio. And that really pushed them in kind of more towards what we call the plus sectors, let's call it high yield, leveraged loans, emerging markets, and preferreds, but then also more towards alternative credit as well. There was also some floating rate exposure I think investors were looking for. So middle market loans, broadly syndicated loans, CLOs, that kind of type bogey. And I think all those are still very important. The yield part perhaps is not quite as front and center, but we still think, considering extending that reach beyond equities, beyond kind of rates makes a lot of sense. As we'll see here in a bit, you can lower your volatility, you have less mark-to-market exposure, you have more uncorrelated risk-reward opportunities, and even this know what you know kind of underwriting credit risk aspect of it, I think is very important. I think Randy and his team does a fantastic job really understanding the sectors that they underwrite, the industries that they favor, and making sure they have that covenant protection. I think that's going to be very important here going into this potentially recessionary type environment. It's certainly very, uncertain environment. And even that, floating rate aspect of it, it's very difficult to predict where the 10-year is going to be going. Rates probably going to migrate higher. So even in this environment, in our view, it has a lot of value in expanding that investable universe. Look across both more traditional fixed income sectors, the plus sectors, and alternative credit, and really trying to find the best value across the different asset classes. Again, Randy, anything you think I'm missing on that?
No, I think you covered it, and I think that, again, this is a point in time. So I think, Anders, when you and I looked at this chart 3 months ago, it's a bit different, but it just highlights the advantages that Nuveen investors have because of the scope and breadth of choices in the market, which is right now, it's hard for people to have conviction because of all the cross currents, but particularly on the direct lending side, just having that low volatility to complement, frankly, your fixed income and even the public equity side of the house has been really a terrific advantage for the house to have all these alternatives for investors.
Great. Yeah. If Sebastian will go to the next slide, I think a couple of key features here that we just want to highlight to the audience is, even more so now when we are in very volatile time, very uncertain times, I think we like to stress to investors that you really need to know the risks that you have in your portfolios and need to understand what those risks are going to be doing potentially to your return. So what we try to do here is show a breakdown of the kind of various different asset classes and really try to break down the factor aspects of it. So, when we look at the parts of the risk that you're putting into your portfolio, I think it's very key to understand if it's more equity related, is it more rates related, is it credit related, or is it more idiosyncratic and perhaps not quite as correlated. So that's another key, in my mind, reason why you should be looking across beyond some more traditional investing, beyond just equities and maybe more rates-driven fixed income investing and kind of expanding into that plus sector all the way through into private credit, alternative credit. Because if you look at some of these bars here, some of them have, again, a little outdated yield kind of type numbers, but yield opportunities that look similar at the face of it, but come with very, very different risks. For instance, if you look at emerging market debt versus senior loans, or if you look at direct lending and private credit has a much larger idiosyncratic kind of type exposure, low correlation versus other asset classes, more diversification, and that kind of ties into, again, this uncertain environment that we're in. You really need to understand your needs, you understand your mandates, what are your investors looking for, and really try to allocate appropriately to take on the risks that are aligned with what those mandates needs are. So I think that just stresses again that it's not a beta type market. You can't just invest in anything. I mean, arguably in Q1 2020, when the Fed stepped in and really supported anything, you pretty much could invest in all parts of the market and done pretty well. That's not an environment that we're in right now. You really need to understand how you're putting your bets on and how you're really expanding throughout the investable universe.
Yeah, all you need to know about having a diversified portfolio and what the reason that folks are driving into senior loans and direct lending is the difference between that core U.S. fixed income profile and senior loans. I mean, mirror opposites, right? Same with direct lending. So, that's the going from a rates sensitive asset class to one where it's really more floating rate, which allows you to hedge against rising rates and also more credit focused. It says it all.
Exactly, yeah. And for instance, high yield, from the high yield side, for instance, that we're quite, quite favorable right now, given the yield levels. If we're not quite sure if we're going to have a soft landing, hard landing, and if we're not quite sure if equities has a little more downside or could potentially start rallying, for example, in high yield, you have definitely a little bit more correlation to equity markets as well. So depending on the views here, for you and your investors, I think it's important to kind of keep these different risk return drivers in mind here going forward. All right, Sebastian, I think we're ready to move on to the next one. So sort of final slide for me here. I think interest of time, it can be a bit brief on this slide, but here we're highlighting a little bit more what we're finding investors typically expect, when they approach private markets, private credit. They do expect a bit of a private markets premium, as I think we can call it. And it really relates to a few key factors. I think, fairly straightforward. The key one is of course, liquidity, or generally illiquidity. Given that when you do typically invest in private credit, it becomes more or less a buy and hold kind of type opportunity and instrument. Time horizon, therefore, generally will be longer. You're kind of locking yourself in for some time. I think an additional sort of premium you need to consider is the fact that it takes a bit longer also to scale. It takes some time to find these opportunities. Randy and his team done an amazing job underwriting, kind of stretching the opportunity set as much as possible, but you can't necessarily put $500 million or $1 billion to work in a very short-term period of time. You have to team up with a team like Churchill to really kind of find those opportunities and have those relationships with the client, so to say. But nonetheless, that does really kind of deserve a little bit of a premium from that perspective. And investors have to kind of assess what the redemption needs for the mandates are, and ultimately, I think, is the private market premium sufficient and a snapshot in time to offset those factors or not? And I think Randy and I will talk a little bit here in a bit, I'm guessing, about that too, given that the public markets have sold off fairly dramatically in a very short period of time, and you kind of have to on an ongoing basis assess if you think that premium makes sense or not. But one approach we favor here is really kind of, again, diversifying and looking across both the public and the private investment opportunities to really kind of taking that best of approach, and at any snapshot of time having some exposure to both sides, and that kind of evens out and has the opportunity for you as an investor to sort of straddle when you think the opportunity set is more attractive or not.
Yeah,
I'll open up to you, Randy. Anything I'm missing there, given that this is a little bit more your area of expertise? Sure.
I think you covered it well. I think it points to the complementary nature of having both the fixed income large cap loans as well as exposure to private credit, because as you mentioned, there is typically built in this, it's really called an illiquidity premium, because that really is what drives, for the most part, the demand for extra yield. Because, Anders, you have the ability to trade in and out when you see, danger ahead from a sector perspective or a market's perspective. You and your team have the ability to, well ahead of time, make both portfolio moves and individual issuer moves to protect yourself. On the private credit side, when you book a loan, you really have it until the loan is paid off, the company is sold, it's refinanced. And so that lack of liquidity on behalf of the investor and on behalf of the manager means that once you commit, you're really relying on that manager, which is why active management is so important. And making the decision up front about the credit that you're investing in is so critical. Interestingly, I think that when you actually get into a workout situation, and again, Anders, most of the time your team ends up avoiding those because you can benefit from secondary market liquidity. But if you're in a troubled situation, the historic data shows that middle market loans actually end up having lower defaults and lower losses, because in a smaller lender group, this is an analysis done by the rating agencies over a long period of time, the smaller lender groups who are of like minds, in other words, they're all buy and hold lenders, so they all have to work together with the issuer and the private equity sponsor as the owner to maximize value and get out of those situations. It turns out that alignment of interest actually works to our advantage on the middle market side. Now, the key is you have to make the right decision about the business that you're investing in going in. But nevertheless, over time, investors still look for this premium, which as we mentioned, isn't existing at this point in time, but over the last 25 years has been the case.
Excellent. Thank you for your insights on those slides, both for Anders and Randy. Really appreciate it, and I'm sure the audience do. Just before we dig deeper into private credit now, I just wanted to send a reminder to the audience that please do send in questions that you have for Randy and Anders. We are going to have a live Q&A at the end, so thank you to those that have already sent some in, but please feel free to send in more. So now over to you, Randy, to sort of dive deeper into private credit.
Yeah, I'd love to dive deep into private credit, and we've got some slides. These are a couple of my favorite, but just backing up a little bit about the market, the private credit market in general. If you think about the last decade or so, ever since the GFC, there have been a couple major trends. We, until recently, had been in a very low rate, if not a zero rate environment. Certainly in Europe, it was the case for a while, and may still be in some areas, that there were negative rates. And so there was a tremendous amount of search for yield. But there's also a high correlation amongst liquid strategies. So everything was trading in sync, both up and down, and investors were looking for alternatives to avoid, when there's headline risk, to be swept along. Certainly we've seen in recent months. And also looking for not just yield, but also safety. So the advantage of private credit being secured, for example, fully secured by all the assets and the cash flows of these companies, having covenants that govern the document that allows lenders to be brought to the table if certain financial benchmarks are triggered, and frankly, having a floating rate asset class for the senior debt part of private credit has created this incredible amount of popularity within the asset class, to the point where today private credit as a universe totals about $1.3 trillion, which puts it right on par with both the broadly syndicated market and the high yield bond market. And there are estimates that over the next 3 or 4 years, that number will grow to almost 3 trillion as a result of the popularity of this umbrella class called private credit. As the slide on the right, the chart on the right shows, banks have been getting out of holding these leveraged loans for decades. And the non-banks have put themselves in a position by raising significant amount of capital, long-term capital, so that they can hold more and more. And as an example, Churchill itself can underwrite and hold up to 500 million per deal, but then we turn around and we distribute that commitment across many, many vehicles, so that the diversity within that portfolio is extreme. There's no, on average, there's no position that even amounts to 1%. I think it's like 60 basis points is our average position hold for any one deal. And so that diversity, as well as the security that I mentioned and the premium rate, has made this a very attractive class. Now, one of the concerns about when you're very popular, it's like what Yogi Berra, the famous Yankees catcher, said about that restaurant. It was too crowded, nobody goes there anymore. And it's a little bit like the knock against private credit. People are saying, oh, it's the market is too crowded, there's too many players. Well, a couple of reasons why that may be not exactly true, and one of which is the chart on the left, which shows the amount of private equity dry powder versus the amount of private credit dry powder. And the dry powder is the amount of money that has been raised by both private equity and private credit funds that has yet to be deployed. And what you see is the light blue columns marching from left to right, which is the private equity dry powder, outnumbers the amount of private credit dry powder by almost 6 to 1. So that means that for every dollar that I'm trying to deploy out there, there are $6 of private equity money that's being invested in transactions. So from a supply-demand perspective, there's just an amazing amount of room for rangers and managers such as Churchill to put money to work. So I think from a technical perspective, this has been a very attractive sort of white space for people, and there's certainly room for us to grow more. I think the other thing that investors ask us, besides is it a crowded space, is okay, great, looks like a great opportunity, Randy, but how do I access these great opportunities? How do I access the private equity market through your private credit managed business? And the answer is that the private credit sponsors is really the key in having a great relationship with them. We have a very unique model whereby not only are we providing financing opportunities as a result of the relationships with private equity, but we also are investing through funds as an LP into the sponsors' funds themselves. So we are in effect a client of that sponsor. We have about 200 funds in which we are investing. And that's a key competitive advantage, because being a client of their business, investing, let's say, in Fund 6, maybe we have a $100 million investment in Fund 6, well, they're already busy raising and thinking about raising Fund 7. And so they want us to invest in that as well. So they're going to continue to show us their best deals. Doesn't mean we're going to do the deal, but at least they're going to show us those deals. And so the access that we have as a result of being a client of those sponsors benefits our investors, because we're getting not only looks from the best private equity investors in the world, but we're also getting them from sponsors that are in the same industries that we like, which are more defensive industries, less cyclical businesses, which we'll talk about in a second. So being able to also provide not just senior capital, but we have a team run by Jason Strife in Charlotte with his team that provides also junior capital solutions to those private equity sponsor-backed businesses. And so we can provide opportunities for investors for senior debt, for junior capital. And we also have a strategy which invests co-investment of equity directly into the private equity sponsored borrowers. So that four-part strategy that we have is really, I think, unique in the market, as well as the amount of scale that we bring. And so that's how we access our market and allow investors to access these unique opportunities. I want to talk, Seb, on the next slide a little bit about what we do once we have the opportunity. So I mentioned the industries that we focus on. I said at the top that we can't predict recessions, but we can prepare for them. And one of the ways that we prepare for them is invest mostly in defensive businesses, such as healthcare, software, business services, technology, logistics, and so forth. As we found over 15, 20 years that these companies do better during recessions. So if you don't know when a recession is coming, but you have a portfolio which is comprised mostly of non-cyclical companies, you're probably going to do all right when a recession does come. And in fact, when COVID hit, we didn't know that it was going to be COVID that caused the recession, but when it did hit, our portfolio was built to withstand the downturn, and as a result, we've had no defaults or losses in the portfolio over the past 3 years, which has been really, really helpful because that allows us to continue to invest. And some of the other lenders in the market are not in that situation as a result both of what happened early in COVID and also what's going on now. So having the right sectors is really, really important. Also, understanding which companies within those sectors to pick. So one of the things that Anders does with his business is he's got tremendous amount of expertise across many, many sectors and has industry focus and specialists within the portfolios to be able to understand which of the bigger companies, the more public, large-scale companies are the best players, and having expertise across many, many sectors. We tend to be more generalists, so we focus on more specific, as I mentioned, non-cyclical companies, but we also focus on businesses that are market leaders within those niches, that have high free cash flow generation, so that if we do hit a recession, the company will have enough EBITDA margins, gross margins to withstand additional interest expense, for example. As a management team that has real depth, so they have been through downturns before and understand how to batten down the hatches when the storm comes through. And also businesses that have a track record of actually going through other cycles to see how they perform. And one of the things, of course, when you get these transactions, not all the deals that we see are deals that we do. We've actually tightened our credit criteria a little more cautious, just given what's going on in the market. So we only actually close about 5% of the transactions that come in the door. That's down from 7% last year. So we're being a little bit more cautious. And then lastly, once we find the right industry, the right sponsor, and the right company, we then actually structure the deal to be the most protected for ourselves and our investors as we can be, with full security, as I mentioned, also covenants, and significant amount of equity that are going into these companies provided by the private equity sponsor below us. So we're the first money out in case of a problem. We have all this cash below us and relatively low leverage. So the diversity and safety of that portfolio is such that, as I mentioned, it's been able to withstand downturn and volatility that we've seen in the market thanks to interest rates and inflation recently. So that's just a quick snapshot of how we rock and roll in our business. And Anders, I don't know if there's anything that jumps out at you relative to the way that you rock and roll.
No, I mean, I think there are a lot of parallels. I think at the core, our side of the business, sort of say that the more traditional fixed income is very similar in our underwriting philosophy, our approach. I mentioned before, in this kind of type of markets, we really do stress making sure you understand what kind of type of investments you're taking, and I think we are at the core also very diligent in how we're underwriting risk, how we kind of working with underwriters and understanding really kind of the sectors that we're in. The difference being, of course, as you alluded to before, Randy, that we have at least the opportunity and hopefully the ability to kind of move around if there's a certain sector that we're not quite as comfortable with, be it COVID concerns, cyclical concerns, what have you. We can try to really be proactive and leverage our research analysts and portfolio managers to really kind of redeploy those opportunities as well. So, but at the core, I think all that you're saying is filtering into our markets. And if anything, I think importantly, the fact that the private credit market is growing so tremendously and it's becoming a bigger pie, it's actually keeping the public issuers, the high yield issuers, the public broadly syndicated issuers a little bit more honest and a little bit more disciplined, because they know there are alternatives now that weren't really there before. And I think it's actually adding a healthier top environment for our side as well as your side.
Great.
Well, thank you both again for sharing your expertise and views with us. There's definitely some interesting insights there for the audience to take away. So now back over to you, the audience. We have another poll for you to take, which is the question: within the private credit space, where do you see the opportunities? And the answers are senior middle market loans, real estate debt, infrastructure debt, junior mezzanine debt, or CLOs. So I'll give you a few moments to respond to that. And in the meantime, Randy, do you have any views on this? Where are you seeing the opportunities?
Well, clearly, senior middle market loans, probably just given the fact that they're floating rate and interest rates are increasing. I think that is the most obvious. I can't speak to real estate or infrastructure, but both actually junior mezzanine, which has always had an audience because of the higher yield that that asset class affords. And even though over the years, there's been some disintermediation from second liens in the public market, from unitranche even in the private market, there are smaller cyclical businesses and certain private equity sponsors that always like to have a layer of subordinated debt in their capital structure. And we were just talking yesterday about the success of our own junior mezz fund and raising money for that. And there's clearly appetite. You have to sometimes find it, but we've seen appetite for that all along. And CLOs even, which are for the middle market now, I'm talking about, present an interesting opportunity for investors because they tend to be one of the few asset classes from an investor perspective that's rated, so you can look at AAAs and AAs and so forth, and single B risk. Probably more sophisticated liability structures in the broadly syndicated CLO market, but certainly with middle market, and even with middle market CLO equity right now, there's real traction. I mean, I think the yields are mid-teens, so that's an area which is getting a lot of attention. So,
great, thank you. Right, so let's see what the results are. 49% senior middle market loans. Any other notable ones? I mean, any of those results there particularly surprise either you, Randy, or Anders?
I didn't make I should have started my ad on junior mezz earlier in the discussion. We would have gotten a little more bump up on that.
That's okay. So we'll moving on now. Again, Randy, are you happy to sort of share unique opportunities in the private credit space?
And this is an interesting slide just because it shows historically what happens over time coming in and out of recessions, right? So we obviously on the far right, we don't know what's going to happen in 2022, 23. And this was prior to COVID, but COVID actually presented a unique challenge and opportunity, I think, for all of us. It was mostly a challenge for consumer-facing companies, and I mentioned that earlier, but it opened up huge growth opportunities for the businesses that we invest in and finance, and that's, again, more business-to-business companies. We discovered it, as everyone else did, in early 2020 when everyone went home and all of a sudden discovered all the things at home that needed repairing and all of the things that people needed to order online from their home that maybe they hadn't thought of when they were actually at work in their offices. And over the last almost 3 years, we've had this boom in B2B, online consumer activity, obviously, home repair and remodel and so forth, and all sorts of areas of growth, and the private equity sponsors have actually seen that. And we as well, I mean, we had all of our portfolio pretty much in those businesses to begin with, but it allowed us, frankly, to take advantage of the fact that our portfolio was built for this type of recession. And when investors looked at the success that we're having, they started to give us more and more money. And so our success in fundraising allowed us to deploy more and more capital. And that coincided, that ability to write larger checks, coincided with private equity sponsors looking for fewer lenders to actually help them with their financings. They wanted to have a few lenders who could do everything, who could write large checks, do senior and mezz and unitranche and co-invest and everything else. And that actually created record deployment for us for 2020. Amazingly, we had a record year in 2020. We had another record year in 2021 as markets normalized a little bit. And we saw, as vaccines kicked in and business kind of came back more to normal, we were a little curious about what was going to happen in 2022. And quietly, we've had another record year, in part because of the success that we've had with our partnerships with these private equity sponsors that I mentioned, where we are a client of theirs and we continue to both invest in their funds, but also finance their companies. But what's also happened is, despite all the inflation and the interest rates going up and all of the background noise, these businesses are doing well. Our portfolio, we did a portfolio review for the first quarter a month or so ago, we actually had more upgrades to the portfolio than downgrades. So, and the percent growth, both in revenues and EBITDA, are double digits. So we seem to have picked the businesses that are doing well. The other thing I'll mention just in closing is the structures, as you would expect, in a volatile time, have actually become stronger. So we have higher yields, as Anders' slide showed, with both senior loans as well as middle market loans. So higher yields, more capital coming into these companies because sponsors are paying more for the better companies, and so there's more cash below us. And because of the general cautionary environment, we're being more selective. So our selectivity ratio down to 5%, as I mentioned. So I think, look, we can't time markets. We're investing all the time. We are financing companies every day, every week, every month, because we need to deploy all the capital that we have raised from our clients, and the clients want yield, and so we're putting that money to work quickly and effectively. So what we're worried about, not so much timing, but realizing that when you do have these opportunities, that you're prepared for them, and we feel pretty prepared at the moment.
Great, thanks, Randy. Anders, is there anything you'd like to add further before we go on to the Q&A?
No, I think Randy did a fantastic job kind of outlining that. I mean, the only thing I'll mention is obviously the yield environment is a little bit different now, as we touched on, that the public markets, some of the numbers that we're seeing here it's a little dated from March 2022. It looks quite different today, but all in all, Randy highlighted that very, very nicely.
Excellent. Well, thank you both once again. So now it turns over to the audience to answer some of the questions that we've had in. Thank you to those that have already sent some questions across. Please do feel free to send some more over, because if we don't get time to answer them all today, then the Nuveen team will come back to you personally. So looking through the questions here, I think actually, Anders, this first one might actually be for you, which is when making the case for adding alternative credit to a portfolio, what were common objectives you heard and how did you overcome them?
Sure, yeah, no, certainly, I mean, we've been on this journey for several decades. Nuveen was one of the first kind of investors in private credit several decades ago. So this is something that we've been embarking on for quite some time, and even internally where we're trying to really get our arms around sort of pros and cons and how to really get comfortable. And I would say a few of the common objectives that we've discussed internally and certainly had from investors is ties into one of the slides I had before around illiquidity, the fact that you have to really tie up your capital, the time horizon, the fact that it's really more of a buy and hold, or it is a buy and hold kind of type approach here. I think those are the core ones. I think depending on the market dynamics, I touched a little bit around the private market premium. At times, that can be debated amongst investors. Is it sizable enough? Do I get paid for taking this additional private market kind of type exposure? And I think at times I also hear a little bit around, is there, a little bit too much demand for the supply? And I think Randy touched on that very well, that the investable market has actually grown tremendously. So the underwriting standards haven't really been stretched. I think it's fair to say, Randy, you should chime in here as well. But, I think at times there's been some concerns. Are the deals being done in the private credit market that shouldn't be done, or maybe it belongs more on the public side? But all in all, I think those are concerns that sort of faded over time. And I think Randy highlighted kind of the overcome part of that pretty well. Randy, anything you would say from your seat that I'm missing on those kind of objections that you're hearing or concerns on your end?
No, I think you captured it. I will say there is more caution in the market in general because of all the stuff that's going on, the concern about where the economy is headed. And I think that, I like to say, it has taken the foam off the latte in the market that we were seeing a little bit more in 2021, some of the irrational exuberance that sometimes happens in capital formation and in corporate finance. And that's all good for investors. So I think, there's a question about covenants. I think that we're continuing to see good covenants relatively tight covenants, smart covenants, and certainly no loosening. And that to us is the key. So there's been a real stability there. And again, when you're dealing with the same private equity sponsors all the time, you tend to lock in the same terms. And so you kind of feel comfortable with the borrowers and the owners that you have. And that's also really critical because you have good success with these sponsors over a long period of time, and you want to have your investors benefit. So I think you did cover it well.
Great, no, thank you. So next question here is obviously investors are familiar with how rising interest rates affect traditional fixed income portfolios, but how do rising rates play out in private credit? And how different are the risks, and what can investors do to mitigate those risks? I think this one's probably for you, Randy.
Yeah, I think I mentioned up front the notion of concern about covering higher interest expense for the portfolio companies. We model in for every deal that we do a recession within 18 months. So, and then we increase the interest expense that they're paying based on the forward curve. So now what'll be interesting to see is, SOFR is, closing in on 2%. LIBOR back in 2007 topped out at 5.5%. So we have a ways to go before we get to that kind of level. And that's setting aside, obviously, all the very high interest rates, in the 1980s and so forth. But to the extent that the Fed tops out at kind of a Fed funds rate of 3% or something like that, I think that certainly most of the companies in our portfolio will be fine. I think 3% as a SOFR number, if we get to that, and then you throw on another, 5% spread, so you're kind of an 8% yield, that 9% maybe worst case. I think that's going to be a number that will test some cyclical businesses for sure. But on the other hand, the benefit for investors is going to be, they're going to be seeing, for these good companies, they're going to be seeing their yields go up. And they've seen that now to some extent. We've seen yields and spreads in the middle market go up 25 to 50 basis points. So it's all about the portfolio construction as we see rates going up and making sure that you've constructed with businesses that can manage it. So that's primary focus for us.
Great, thanks, Randy. Obviously, we've had quite a few questions come through on ESG. So I'll ask an ESG question for you, sort of both to chip in on. It's said that certain types of ESG or impact investments, such as renewables, can only be found on the private credit side. Is this true? And what are the unique advantages of private credit from an ESG perspective? And are there any additional risks associated with that? I mean, I'll start with you, Randy, again, if you don't mind.
Yeah, it's I don't let Anders comment on the public side, but it's not true that it's only present on the private side. In fact, Nuveen has significant exposure and expertise in renewables. In fact, I believe they have both a wind and geothermal project. I was just looking on their website in fixed income. So there's a public alternative. I think the advantage in private credit is our alignment with the private equity sponsors who actually own these companies. So we, as a lender, have a limited ability to actually affect what's going on with the businesses in terms of the day-to-day operations. That's not our job. That's the owner's job. But we do have the ability to select companies that are within sectors that are ESG friendly. And we have a very sophisticated reporting system, which involves obviously negative screening, so not avoiding industries that are not ESG positive. But even within the screening and the data collection, we have an ability to partner with those sponsors. And in fact, we've created a strategic partnership with Kohlberg Capital, which is a leading middle market private equity sponsor. That they have their own ESG expertise in going out to the private equity sponsors with them and saying, hey, we have a template that we've developed with Kohlberg association, actually with PRI, which is another major global ESG consultant, to help you track what's going on with your businesses in terms of carbon footprint and so forth, and answering those questions, because some of these small companies, it's really hard. Like, what is the carbon footprint of a fitness center? It's some of these are with small companies. It's hard to sort of figure that out, and so we think the critical thing is getting investors the right data, and so helping the sponsors figure out actually what these portfolio companies, what the benchmarks are, and getting that data back to us and to our clients. So it's a white space out there. Europe is ahead of us, frankly, ahead of the US and ESG, but we're rapidly catching up, and we've got the resources to do it. Anders, I know you probably got some stuff going on the public side.
Yeah, no, as you said, Randy, there are plenty of exciting opportunities on the public side as well. And I think it's important to kind of remember the E, S, and the G. It's not just, kind of the renewable space and environmental spot, the S and the G, and it's very important as well. And in fact, Nuveen, once again, been in this space for a very long time. In fact, I think we're one of the largest third-party investors. We have roughly about $20 billion in third-party assets under management on the impact side alone on our team, on the fixed income team. And there are all kinds of exciting and very important kind of opportunities that we have been able to help finance. And we really focus on the use of proceeds, so it really has to be direct and measurable. We take a lot of pride in making sure we understand exactly what the use of the proceeds will be, as opposed to just giving into a company and hoping that they will do something good with it. So things like supporting fish farms in Seychelles, or just here recently, I think a month ago, we had a big deal that we were part of for rhino preservation in Africa, for instance. So it is a very broad base and a very exciting base, both on the private side and the public side.
Excellent. Well, I think we will wrap up there, both, because I do think we're sort of running out of time now. So, but I just want to say a big thank you to both of you for, sharing your experience and more importantly, your time with us today. It's been a really interesting discussion, at least from my perspective, and I'm sure the audience have really enjoyed it too. To the audience, if we didn't get down to your question, as I mentioned previously, the Nuveen team will be sure to follow up with you. And Nuveen will also be emailing, we will be emailing out a replay of this webinar for you to watch as and when on demand, and Nuveen's paper titled 10 Considerations for Building Strategic Allocations to Alternative Credit. I hope you've enjoyed today's webinar, and you can look forward to seeing more future insights from Nuveen's Equilibrium Survey of institutional investors later in the year. So before I end the webinar today, I do have to read some disclosures quickly. So the views and opinions expressed on today's call are those of the presenters as of 14th of July 2022 and may change at any time based on market or other conditions, and there is no assurance that any predicted results will actually occur. Any holdings information discussed are as of the most recent quarter end and are subject to change without notice. Financial professionals should independently evaluate the risks associated with products or services and exercise independent judgment with respect to investing. So with that concludes today's webinar, Allocating to Alternative Credit. Thank you for watching, and goodbye.